Hello, I'm Peter Herbert. Welcome to our latest short CPD webinar, looking at topical aspects of financial reporting and auditing. This month's webinar is Hot Topics in Financial Reporting, and looking forward into 2023 at some of the challenges facing accountants and a couple of interesting changes coming down the line that we'll get more visibility of in the early part of next year. Just to sort of make an initial point before we get into those more crunchy topics, if we could, is that from the point of view of 31 December 22 year ends, the good news for many is there are actually no new financial reporting rules from a UK GAAP point of view compared to where we were this time last year. We have had during 2022, in fact, in the early part of this year, a new edition of FRS 102, but all that really does is take the previous March 18 version and bolt on one or two changes that have occurred since. It's just therefore simply a consolidating version. It now becomes the January 2022 version that will certainly apply to 31 December 22 year ends. But whether you're preparing an account using FRS 102 or FRS 101 or FRS 105, the good news is that from the 31 December 22 year end point of view, there are no changes compared to what was there from 31 December 21. Now, in terms of looking forward into 2023, I guess what we should also initially just kick off with here is the fact that there are, with uncertain times ahead, some quite key challenges from a financial reporting and auditing point of view. This does, to me, feel a bit like Groundhog Day. A lot of the points we're making about the current economic climate very much resonate with what we were talking about 2.5 years ago when the pandemic hit. Anyway, here goes. First up, remember that in difficult times, very important to make sure that you're telling the story about what's going on and about the future prospects in your narrative report. That's obviously particularly key for medium and large companies, whether it's the review of the business in the strategic report or whether it's commentary around financial instruments in the director's report. Difficult times get us thinking about impairment. And certainly from the point of view of impairment of fixed assets, we always say, don't we, that a material shift in market interest rates can very much trigger the need for an impairment review, if not an impairment write-down of fixed assets, because material shifts in market interest rates can impinge on value in use calculations and, for that matter, fair value calculations as well. So I think impairment of fixed assets going into 2023 will be certainly one for accountants and auditors to keep an eye on. And with lots of volatility currently in the commercial property market, one would imagine lots of challenges around investment property valuations going into next year, and also, of course, the related deferred tax liabilities, those applying FRS 1 and 2. Going concern, we gave lots of coverage to 2.5 years ago when COVID hit. Sense I get talking to people on courses is that in terms of the current climate, the current outlook, many of our clients are, if anything, more gloomy now than where they were 2.5 years ago. And of course, where going concern does rear its ugly head as an issue, there's important considerations in terms of accounts. So if there is a material uncertainty, that's a significant doubt on going concern, that's got to be explained in the notes to the accounts of a company applying FRS 102. And it's also got important ramifications for the audit report as well, where that going concern uncertainty would need to be flagged up. Derivatives was a topic we covered a lot when FRS 102 first came in back in 2015. Of course, under FRS 102, derivative instruments are fair valued, and year-on-year movements in fair value go through P&L. That would apply typically to a forward currency contract. That would apply to an interest rate swap and other types of derivative instruments. Now, what I've observed in the 7 years since FRS 102 has been with us is that very often these derivative values and the fluctuations in those values don't tend to be material. I'm not sure, therefore, from an accounting point of view, whether this gives quite the issues we perhaps thought when the standard was first introduced. But I think in the current climate, it might be that these fluctuations are material, and therefore derivative accounting is something we really need to embrace now, perhaps in a way we haven't really embraced it over the last 7 years or so. Again, something to look out for, certainly, going into 2023. And finally, and a little bit more niche probably, is thinking about defined benefit pension scheme liabilities. So if you're looking at the preparation or audit set of accounts of a company with a defined benefit pension scheme, the defined benefit pension scheme liability, of course, comes onto the balance sheet of the sponsoring employer. And because that liability is impacted by things like inflation rates and interest rates, one would again imagine potentially quite significant fluctuations in liabilities at the current time. And again, therefore, important challenges from an accounting and auditing point of view going into 2023. Just drilling down on that issue about pension scheme liabilities, the way it works, of course, is that your net liability on the balance sheet of the sponsoring employer is taken by comparing scheme assets at fair value and scheme liabilities at net present value. So future payments of pensions to scheme members going into the future, discounted back to net present value using a yield on high quality corporate bonds. What I'm observing currently, based on discussions with some firms, is that because bond yields are increasing, that in some situations is causing the NPV of scheme liabilities to decrease, so that that figure is lower than fair value of scheme assets. And therefore, whilst historically we generally tend to get a net pension scheme liability on the books of the sponsoring employer, as in this example, it might be in some situations going forward, we get a net pension scheme asset. Now, from an FRS 1 and 2 point of view, that can indeed be shown, but it is important in order to show it, that it can be demonstrated that that net asset is recoverable going forward, either in the form of repayments from the scheme to the sponsoring employer or reduced contributions. And that's an important consideration for auditors going into next year if they're going to sign off on accounts where that net pension scheme asset, where it arises, is indeed recognised on the balance sheet. Okay, changing direction then. Another thing to look out for in the early part of next year is movement on Companies House reform. You may recall us talking a lot in the early part of this year about the Corporate Transparency and Register Reform White Paper published back in February. We've been waiting all year for that to get converted into an Economic Crime Bill and then an Economic Crime Act. That's not yet happened, but we are expecting that in the spring of 2023. Now, this white paper brings in a range of reforms. The one I want to just drill down today is the particular reforms around accounts preparation and accounts filing. And there are four, I suppose, that from the point of view of day-to-day work that accountants do are particularly worth keeping an eye on going into the early parts of next year. First of all, you may recall that what the legislation is likely to do, again, we don't know for sure, but it's likely to do, is to limit the number of times a company can reduce its accounting reference period. And I think over the years, there's been much scope to, just before the filing deadline, reduce your accounting reference period by as little as a day, and then buy more time, buy 3 months more to file. And you could do that on a number of occasions over. Currently, the law says that if you're looking to actually extend your accounting reference period, you can only do that once every 5 years, except in very specific circumstances. And what they want to do here is change the rules regarding the reduction of the accounting reference period and bring those into line with the rules around extension, whereby it can only be done in normal circumstances once every 5 years. So look out for that one in the legislation in the early part of next year. Small companies currently allowed but not obligated to prepare and file abridged accounts. That will be a regime that will go away. So abridged accounts not popular with many and will be no longer allowed if and when this particular legislation does land in the early part of next year. And more interesting and more controversial, I think, is removing the ability of small and micros to file filleted accounts at Companies House, where they remove the director's report and the P&L. Now, that's certainly been very contentious. The white paper, I think, will very much convert this into definitive legislation going into the early part of next year in terms of that economic crime bill and economic crime act. And one would imagine this is a bit of law they can bring in quite quickly. Now, we've had huge pushback. I get a sense from some that if they are perhaps acting for small companies or micros, where perhaps they have got big suppliers, big customers, and they really feel that to actually divulge the turnover, divulge the profit to those big suppliers, to those big corporate customers, could be very damaging in terms of their relationship, whereby they then get screwed down on price. I've even had some firms say that that might cause some of their clients to move to an unincorporated business model. But this does seem likely to stick. So again, watch out for the legislation in the early part of next year. And really importantly, I suppose, watch out for when this will become definitive. One would imagine quite an easy thing for them to bring in quite quickly, but keep an eye on that certainly in the early part of next year. The final point, and more reassuringly, is that in earlier consultations around company tax reform, they were advocating that we might reduce filing deadlines. So 9 months to 6 months to private companies, 6 months to 3 months to public companies. That's not going to happen in the short term, but as the slide says, the legislation will facilitate future changes in that area, but no expectation we'll get those changes anytime soon. The final thing to be looking out for in the early part of next year, that again, we were probably expecting before the turn of this year, is some more definitive guidance in terms of where we're going to be with the next periodic review of FRS 102. Now, that seems likely to actually take effect from periods commencing 1 Jan 25, so 31 December 25 year ends and afterwards. That's not completely definitive, but it won't be earlier than that. And this is therefore some way in the future, but we are expecting the exposure draft culminating in that revision to land very, very soon. And that's what I want to talk about briefly in this final segment of today's short webinar. So you may remember that the FRC sought general feedback on the current iteration of 102 in the middle to late part of last year, 2021. We're therefore now expecting any time the exposure draft amendments to the revisions coming into play from periods commencing 1 Jan 25. That was expected, late 2022. That probably seems less likely now, but one can only imagine, along with the company's house reform stuff, that we will get some sight of that in the early part of next year. And therefore, if you've got strong views on this, do put those forward to the FRC during the consultation period. They can then get explored like all the other consultation responses to inform the definitive revision, which will get published some months later. Now, there's a whole bunch of things that may inform the next version of 102. You may recall from the sessions we've run all the way through this year that the very interesting discussion point is how the relatively new IFRS changes in relation to IFRS 9 financial instruments, IFRS 15 revenue recognition, and IFRS 16 lease conduct, how they will inform the next iteration of 102. And what the FRC have been doing, I think, and why they've been kind of delaying a bit on the actual publication of the exposure draft of the new version, is just seeing how the ISB and their IFRS for SMEs exposure draft amendments are going to deal with these changes, and that might to a point inform what we put forward at a UK GAAP level as well. And the really interesting one, I think, is IFRS 16, which, as you may recall, brings pretty much all leases on balance sheet for the lessee with a corresponding right of use assets in the balance sheet as a result. So you're fundamentally treating operating leases as finance leases and bringing all leases on balance sheet as a creditor with a corresponding asset in the top part of the company balance sheet. Now, interestingly, what the IASB have chosen to do in their exposure draft amendments to the IFRS for SMEs is they've chosen not to go with on-balance sheet presentation for operating leases. Now, the key thing to look for, therefore, in the early part of next year is, will the FRC follow suit and leave IFRS 16 amendments out of the next iteration of 102, or will they go their own way and will they bring them in? If I was a betting man, I would say they'll probably bring them in. What I think is an interesting thing to keep an eye on is to what extent will those rules, if they do come in, simplify the basis on which leases are brought on balance sheet in IFRS 16 world. Again, remember that IFRS 1 and 2 is supposed to be a reasonably simple, reasonably straightforward regime for private companies in the UK. And if they do bring it in, how will they embrace the rules for smaller companies? Will they bring it in for all companies applying 102, including small companies applying 1A? Will they bring it in for IFRS 105 companies, which again, even lower down the scale in terms of size, and one would imagine generally in relation to simplicity of accounting rules? Now, again, my thought would be probably they'll bring it in from a 102 point of view across the board with quite significant implications, but will not bring it in from a 105 point of view. But that's complete conjecture. We do await the exposure draft with bated breath, really. And again, one would imagine as we get to the end of 2022, we can expect that in the early part of 2023. Let's see what they do recommend, and we can then provide feedback and see to what extent that gets reflected in the final version of the standard published, one would imagine, in the later part of next year. So lots to be thinking about there in terms of difficult times, in terms of companies house reform, and in terms of reform to IFRS 102. And they're all topics we'll cover in detail during our courses during 2023. Hope that was useful. Any questions or comments about this particular session, do drop us an email at inquiries@insight-training.co.uk. And for more information about our full 2023 programme, our website address there is the place to go for all that you need to know. Thanks for listening. Have a great holiday season. I'll see you all in 2023. Thank you.